looking at the fiscal impulse. We've had a lot of fiscal stimulus over the last 18 months, and we're looking at this chart to show the projections that it's going to slow down and even reverse at some level. So that the impact of that on GDP will be pretty impactful. So walk us through what we're looking at here.
Yeah, the green line, the solid green line, that's year-over-year GDP growth. So these are numbers we see all the time. Everybody's aware of what GDP growth is doing. The blue bars are the fiscal drag or boost. So basically how you would view this is if the economy outside of government spending is growing at 2%, for example, and fiscal spending is only growing at 1%, well, then that would be a fiscal drag. Fiscal spending is detracting from GDP growth. It would have been higher had they spent more, right? Which is always true.
Mhm.
A fiscal boost is what we saw during the COVID-19 recession. So you see the blue bar is almost 15%. So the growth in government spending, and this is state, local, and federal government spending, exceeded the growth or lack of growth in the rest of the economy by about 15%. So it's almost the same as saying GDP growth during Q2 2020 would have been about 15% worse had the government not stepped up and did the stimulus. It almost works out like that mathematically. So what we're seeing is, we're always looking at the rate of change year over year. That's what a GDP growth measure is. It's sort of what have you done for me lately? And same thing with fiscal spending. So state, local, and federal government spending as we get into Q2 of 2022 is going to have a fiscal drag of about 3.3% is the current estimate. And you can get into a lot of debate as to, well, how much of Build Back Better, how would that factor into this? Build Back Better is a 10-year plan. It's going to have a pretty minimal impact in 2022, even if it gets passed, because a lot of the spending early on is going to be offset by some tax increases somewhere. So net, it's not going to have a big impact. This is pretty much baked in the cake that this year we are going to have a fiscal drag. How tolerable is a fiscal drag of this magnitude in a midterm election year when the Democrats still have control of the House and the Senate? That's going to be the question. And how tolerable is this big of a fiscal drag if inflation runs hot and folks are struggling, they're miserable, they can't afford things, the labor market doesn't heal as fast as it should, or the economy falters because of COVID?
Mm-hmm.
Not very tolerable. So in our view, if this is what's baked into the cake and the market seems to be comfortable with it, well, it can probably only get better in terms of the surprise. It's most likely not going to get worse. We're not going to see a bigger cut in fiscal spending, right? So you just look for little sprinkles of additional spending throughout the year as we move into midterms. In our view, governments are going to be looking for just about any excuse to add a little bit more fiscal spending to boost these numbers. So that's sort of, in our view, it's so negative right now, it almost can only be positive.
Yeah, the probabilities are definitely to the upside here for that. And as we move closer and you hear talks of potential tax law changes, depending on how those go, if there's not a lot of stimulus behind increasing taxes, you could see a boost from that as well. So what impact does this type of deceleration have on stock market returns?
So in our view, growth, even with this type of a fiscal drag, is still going to be steady enough to support earnings and stock prices. A huge theme in our outlook, what we've been talking about all along, is not necessarily the data. We're not worried about a recession this year. That seems like a very low probability event. What we're more worried about is how does someone like the Fed, central banks, react to slowing or moderating economic growth? Do they make a policy mistake? Classic mistake of, over hiking into a slowdown in the data, right? Hiking interest rates too quickly. that is what the market would react to. They would react to the reaction of the central bank,
Right.
not to the actual data, which will probably be just fine. So we think this is a known, right? And the stock market's at all-time highs, and earnings expectations are still near double digits. So we think the market will take this in stride. It would just be a significant surprise in how the Fed reacts that could hurt the market.
Yeah. So that's a great look back at last year and at some key things for this year. Can you just sum up our base case outlook to wrap this up, our base case outlook for 2022?
Yeah. And it's, sort of a summary of these key charts that we just shared here. So one is we think inflation is going to start to moderate, especially as we move past April 2022. As that happens, it will allow the Fed to effectively underdeliver on rate hikes, which will be key to the market. And if there are any hiccups along the way, we think there's potential for state, local, and federal governments to provide a little more stimulus, which would also support markets. So it's going to be volatile, especially as we get into the middle of next year, because the Fed is going to be reacting to rapidly changing data and a moderation of inflation and a moderation of economic growth. So there will be volatility there. There'll be volatility in the early parts of the year, most likely, because we're dealing with a massive wave of COVID cases. So what type of volatility does that bring within the market, if any? But all in all, what it looks like is definitely lower returns than we saw last year, with more volatility, higher probability of a 10% correction peak to trough. But especially as we get into the back half of the year, we think it's still pretty constructive. And most importantly is TINA still holds, right? Equities still are the only game in town. So even if you wanted to reduce your equity exposure to avoid a 10% correction, I mean, what are you going to put it in? You're just going to hide out in cash or bonds, and then you're going to be looking for an opportunity to redeploy into equities, most likely. So
We love Tina.
yeah.
All right, that's going to do it. Thanks to our research team for the great charts again, and we'll look forward to a great year.